Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Welcome back to Real Vision. I'm Ash Bennington. Today, I have the pleasure of speaking with a fan favorite, Cem Karsan, founder of Kai Volatility and Kai Wealth. Before we get started, don't forget tickets for our upcoming in-person crypto gathering in Miami are now up for sale. Head over to realvision.com/CG2025. That's realvision.com/CG2025 to get yours. With that said, Cem, always a pleasure to have you on the show, especially great to have you on the show. We talk about these ideas of pivots, jump conditions in markets. We had a little bit of one yesterday with options expiry and, of course, Fed news, Fed guidance, rate cut, big picture, 50,000 foot. Tee it up. How are you seeing what's happening in markets right now?
So we like to talk about macro and flows. You're getting both today and yesterday in a major way. We have been talking about for some time the structural inflationary pressures that we're facing, and they're just accelerating. So that's the macro piece. We've seen break-evens on the two-year break-evens go up 0.9% since September, almost 1%. You're talking from a 1 point.
Tee this up for folks who don't follow break-evens as closely as you do, who don't follow fixed income. Talk about what this is and what the significance is.
Yeah, break-evens are the measure expectations of inflation in the market. And the way you get that is essentially looking at tips and subtracting what the equivalent T-bill or bond rate is. So that difference is...
This is the inflation-adjusted instrument versus the floating rate instrument. You subtract it out, you get effectively what the market perceives to be the market perception of interest rates.
Correct. And even though we had a lot of inflation early, that really... has been muted in the last several years, despite a lot of talk, yours truly and among others, about the coming inflation that we saw. And starting in September, that turned around big time. It started rallying and is now hitting new highs, right around 3% inflation expectations for the next 2 years. That's again up almost 1%. And that's for the 2-year inflation expectations. 5-year expectations have also come up dramatically. And that's the big story here. And that's what the Fed reacted to, despite a lot of people not thinking they would. And we can dive more into that as we go further. And the other big thing is, we've talked about this as well, that you get volatility compression going into this holiday, kind of these last 2 months. And then behind that is increasing volatility long term, especially with a new president. A lot of the departure of a lot of these flows that are supportive and pinning a vol, and so we've been eyeing watchfully, an increase in vol, and it came out a little early here. But that's not a surprise, really, given how weak it's been. We had this a bit of a litmus test in the last.
And let's talk people through it and take nothing for granted in terms of what people understand about what happened yesterday. We had S&P sell off around 3%, back up in Treasury yields about in the 2-year, especially the short end of the curve right now here at the open on Thursday, December 19. We're roughly about 50 basis points higher on the S&P 500, about same roughly on the Dow. VIX right now trading down a bit from yesterday's spike at around 22. I just want to frame this up for people so that they understand, in case not everyone spends every minute and every waking breath watching these markets. Sometimes they catch it, they phase in, they phase out. I just want to set the stage a little bit here for what happened yesterday, what we're seeing today. Give us a little bit of a frame on what that volatility, I know you're just talking to this, but give the 50,000 foot view of what just happened and how significant the magnitude of it was in your view.
Yeah, so let's start with first, this was December, tomorrow, Friday morning, is the big quarterly DEES options expiration. It's called quad witching. It happens 4 times a year, but the December one is by far the biggest because these December options are on the board for years. They are leaps before they become kind of the regular December options. So there's a ton of open interest On top of that, the majority of structured products, which we've talked about on here and other places, are tied to these expirations. So if you think about it, just a massive amount of open interest and positioning in these expirations. So as you get closer, a lot of the kind of structural flows that have come out going into expiration have faded, but you still have a lot of open interest out there on the tails. And in a situation where something odd happens or big happens all of a sudden, that is a tinderbox. It really can cause dramatic moves. Big quarterly options expirations are often the biggest driver of some of the biggest crashes and issues we've had. The March OPEX, drove to a great extent the COVID 30% decline. Again, it wasn't the catalyst. The Fed was the catalyst today, then it was COVID. But the fact that we got a 1 month, it happened from February OPEX all the way to March OPEX to the day in that period. And those things are accelerants. They can really drive massive moves when they start to happen. And we saw that yesterday. The Fed was, again, the catalyst, but we saw, there are sellers of puts out in the world, and they pick up nickels in front of, the steamroller. There's a lot of dime selling, in the short dated expirations. One customer in particular was short 100,000 10-cent puts. They were trading $5 yesterday because he had to come buy them back. There are lots of other similar types of positioning that once it gets stressful can cause a dramatic acceleration in downside moves because ultimately people who are selling these have to sell puts. These drive dramatic declines. Now,
hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
And this is just to frame up for people who understand your thesis a little bit. Obviously, we've been on and talked before, but these people who are picking up dimes in front of the bulldozers by selling puts, these are the folks who are structurally short volatility, the expectation that tomorrow is going to look like today. And when it doesn't, that small payout that they get for the normal condition gets wiped out dramatically in the jump condition, as you just described.
Yeah, 95% of the time things go well. You collect that nickel, right? And 95 times a nickel is, almost, it's almost a decent amount of money. You can get a decent revenue by doing that. But the problem is once that steamroller runs over your hand that one time, the payout, the cost tends to be much more than the collection. Yeah, or at least you pay it all back at that moment. So
to continue in that, when the steamroller runs over your hand once, your hand gets broken and you're not able to pick up the nickel the next time.
Yes, that's exactly right. So at the end of the day, these things they can have massive feedback loops to markets. They are nowadays, given the size of the options market, one of the biggest causes of movement. Today's bounce back is a function of those puts coming back down and all the great sales at $5 that people got to sell on these way out of the money puts because this entity was blowing out essentially, among others. Now they're buying back their futures to lock in that edge. And that's like the bounce we have here. Now, there's a reason why these quote unquote dead cat bounces happen. This is it. Because if something doesn't happen or if it's not a big enough continued move given the volatility increase, then there has to be a buyback on the volatility compression. If it doesn't sustain and keep going, we will continue lower again. But this is kind of the price action we're seeing. So volatility is very much a part of everybody will be talking about the Fed. We should talk macro and the big picture and the catalyst and what's happening long term. But the actual size and scale of the action yesterday and today are very much driven by the vol markets and the fact that this is the biggest OPEX of the year. And there's a massive amount of open interest.
Yeah. And by the way, for the setup for this, I believe it was 2 months ago when we had this conversation where we went really deep on this, where you were talking about this idea that, listen, this isn't the tail wagging the dog. In fact, the tail and the dog have switched. What's happening in the options markets, what's happening in derivatives is fundamentally driving what's happening in the cash markets, which I think is a little confusing for many people to get their head around, that it's not being driven by fundamentals in the short term. It is not the weighing machine, it's the voting machine in the short term. And that thesis that you just unpacked, that you just unfolded, makes that very clear in terms of the specific mechanics that we saw unfold yesterday and the ultimate impetus for the volatility we see.
Exactly. And at the end of the day, options are the full distribution. They're every node on the asset that they're based on. And the underlying asset is just the expected value, mathematically speaking, of that distribution. So when parts of that distribution explode higher, let's say in the put wing like we saw, right, the expected value has to move down. And that's essentially what we're seeing. And when that comes down, all of a sudden you get a move back in the expected value. And that's what we're seeing. Mathematically speaking, that's what's happening. It's all being driven by market makers, dealers, those that are warehousing this risk and providing the liquidity between both sides of the market.
Well, that brings us full circle back to what you said at the top of the show, that we had macro and we had flows yesterday. You described mathematically what was happening on the flow side, which we've just been discussing. And then you also teed it up mathematically at the top of the show, talking about the macro component of this by talking about the break-even spreads and what that implies. Tell us in a narrative format what you see happening with inflation. This is an important one. This perception of what the Fed reaction function is in terms of their balance of risk perception between the risk of decelerating growth and the risk of increasing acceleration in price increases. Let's talk a little bit about that from a narrative perspective. Talk a little bit about what you saw yesterday and what you think it means.
So wage growth is running at about 4%, has been now, not slowing down in any way, shape, or form. Why is wage growth so strong? Because there's less supply than demand. At the end of the day, there's not enough labor supply. A lot of that is driven because of protectionism. We're onshoring and nearshoring a lot of new jobs, a lot of old jobs that used to be here that are coming back. Part of that is because of the bifurcation between us and China, which I think we'll get to later. Part of that is because of labor rights. Part of that is because of fiscal spending. But at the end of the day, there is not enough supply of labor to meet demand. That is keeping services inflation, which if you think about services versus goods inflation, services inflation is essentially the domestic. You can think of that as like the domestic part of inflation, because services are things that you generally, not always, generally have to deliver in person, or there's a much more human component. About 75% of services inflation is humans providing service. The other part is real estate, which is also domestic. Right? So rents, et cetera. That part has been running close to 5 consistently, 4.5 or so. And again, is very much in line with that services inflation number. That's been the problem with inflation. Goods inflation has actually been negative, and it's been keeping a lid on things. And meanwhile, gas prices have come down dramatically. So you're seeing non-core inflation come down. Core is staying high because of services. But on top of that, you're really seeing this services part be the important part, and that's the part the Fed looks at. They look at what's called super core, which is again the services part of that core. At the end of the day, that inflation is going to not only be sticky now. It's if anything, it's been held at bay by historic immigration. We've had 3 million in 2023 illegal immigrants enter the United States, 2.5 million in 2024, about 1 million legally in each of those years. So you're really talking about, on average, about 4 million people entering the United States to help meet that supply-demand imbalance, because the administration is allowing that, and because there's just a massive amount of demand. If there's some demand for it here, people are going to come across the border because there are jobs available. If you don't stop it. And that's been actually, I think part of the idea, a non-political commentary, whether it's popular or not. If there's If there's massive labor inflation, we need supply to meet it. Otherwise, we're going to have inflation. So they've been laying in. That was unpopular. That's part of why Biden is no longer in office and why Trump is on that policy of strong immigration. If we are going a strict immigration policy, if we were going to close the border, if we're going to deport illegal aliens, you can only imagine what's going to happen from here with that inflationary pressure. So I think that's something to keep an eye on, given that we're going into a new administration. And that is the primary driver. On top of that, because of now the proposed view on tariffs and more goods protectionism, if there is a follow through on that, that's actually going to make the goods part of the inflation worse as well, which is the one part that's been keeping everything down. So the reason break evens have exploded higher is because of these two things primarily, that service inflation is not only not coming down, but it's staying stickier and going slightly higher, while goods inflation, which has been negative, is starting to turn higher as well. The Fed has seen this, and you're starting to see dissent and talking about, hey, we can't whistle by the graveyard on this inflation piece anymore. Growth has been relatively strong, but more importantly, those long-term break-evens are breaking higher, and we have to do something about it. And that's why the dot plot changed, and that's why you saw significant dissent. That's at least part of the story, right? But there's also a little bit of a political element that we should probably jump into as well.
Well, let's touch on the political element in just a second, but I want to get a little bit of sense of what the mathematics looks like here, how you essentially map the costs of the perceived rate of the either slowing or inverting of the immigration into the United States in terms of the cost for that with inflation here, as well as the attempting to price the aggregate impact of where tariffs may ultimately land, whatever the game theory is of that as a negotiating point, and calculate that into inflation breakers. I mean, it just seems like it's really hard to map those two, right? Like,
of course,
to get
precise. I mean, you can't be precise. It depends on a lot of factors, but you can get the direction and trend right, and you can even get the scale in general right. The reality is, like I said, we're getting 4 million people of new immigration supply a year. That's where we've been. That's a huge number in the context of 160 million, by the way, working people. So you're talking about, we're getting about 3% labor supply a year in the door. Imagine now you stop that, and then even worse, you start actually sending people out. We're already in an inelastic supply demand imbalance on these things because there's just not enough labor. So people are saying, well, you got to pay me more. And if you don't, then good luck finding somebody, right? So
does anyone believe that we could get to a net negative inflow in terms of workers, that we could actually see that 3% invert and go below the origin, below the zero line?
Personally, I don't think we're going to be deporting. I mean, there'll be some bluster, there will be some, illegal, felony, there'll be big political kind of, yes, we're sending people back. But I do believe they're going to try and close the border. They want to make a big political point there. The immigration policy is a big thing that they ran on and that people voted them in for. And it is the most populist, if you look at history, xenophobia is at the tip of the spear in terms of populism and labor rights. So that's what they ran on. They're going to deliver it one way or another. You can talk about scale and how big it is going to be, but I think that's given how bad it's already been in terms of services inflation. I think you can only expect it to get worse from here, given those policy changes. So I think that's the big takeaway on the tariff side. We'll see. I have skepticism more than the immigration side there, that they'll talk big and then use that as a art of the deal bludgeon to maybe actually go the other way on some of that stuff. But we can talk about that in depth later.
Well, this is really interesting because I guess the difference is on the tariff side, you can actually do the opposite of what the tough talk is and still claim victory. What does that mean? I mean, essentially, you can use it. This is the game theory thesis about the tariff position as a negotiating position. You even saw our incoming Secretary of Commerce, Howard Lutnick. I don't want to mischaracterize his remarks, but is saying in essence that this is, you guys don't understand this. This is the art of the deal thing. This is the notion of staking out a very strong negotiating position, and then figuring out from there, is there some way of finding a mutually beneficial view on trade. By the way, for people who have followed the incoming president, Mr. Trump has been talking about the United States getting terrible deals with regard to trade policy now for decades. I mean, this is literally a view that dates back to the 1980s. He's been remarkably consistent about this. And the question is whether or not, as you suggest there, whether or not there can be a deal to be found by talking very tough about trade and perhaps not needing to implement these very high tariff walls, which I think is something that nobody really wants ultimately.
Yeah, I think there's a to cut to the point here, to the chase. Much like Nixon, who had massive anti-communist credentials and was very much seen as a hardliner Republican, opened up China. Right, he's the one who really created this 40-year expansion in China and the growth between the U.S. and globalization. Much like Nixon did that, Trump is actually, because he has such anti-China, strong protectionist. He calls himself the tariff man. Only the tariff man can actually do a détente, in my opinion, with China. Now, whether they'll be able to or not. Whether that's politically palatable in a populist environment, we'll have to see. But I do think people are underestimating the probability that he could actually make a deal with China. And if he does, that actually is a really big deal in terms of structurally bringing down inflation, particularly on goods inflation, but also potentially on some other parts as well. But that remains to be seen. I think Chinese stocks are priced in a way where you can really get an asymmetric bet on that. I think people, again, are thinking that there's a 5-10% chance of a détente when it's probably more of a coin flip in the next couple of years. And given where Chinese stocks are priced relative, especially to U.S. equities, an incredible opportunity to buy calls and to get some convexity in those types of products. So something to think about.
Well, one of the reasons why that is a coin flip or is perceived as a coin flip is because we simply don't know what the ultimate position that the Chinese are going to assume on this, right? I mean, that has to be a huge part of the game theory here, whether or not they see this deal that is obviously going to be something that they're going to look to do as in their interest. I mean, that's the real challenge, isn't it?
I don't know. I don't know if I agree with that, Ash. I think the Chinese we know want to. They want more of what they used to have, because unfettered China will continue to grow and rise, and their goal is to get to a point where they can challenge the current Western world and stand toe to toe with them. As it stands, the pressure that the U.S. has been exerting on China for really 8 years now has put a significant dent in Chinese growth. It has been a very pro-U.S. policy from both presidents, and it's made it hard for China's continued ascent to continue. So I think China feels strongly they're willing to pay some amount of money now to keep things as normal, to get themselves growing back to where they were, maybe to challenge the U.S. and the West another day. I think it's more of a question mark of whether Trump and that administration is willing to, not continue that pressure, which is more of a long-term view, right? And for short-term gain. I would say, for a 4, 8, maybe even 10-year benefit to the U.S., that would be a short-term economic benefit to reopen globalization and to trade with China. But the ultimate beneficiary that over the long term will probably be China if we do that. And I think that's the big question: is what is this administration going to do? What is their view, long-term versus short-term, about challenging China? Again, a détente would be a short-term positive to markets, to the global economy, but that's not necessarily a long-term benefit to American supremacy or the American economy writ large.
All right, I got 2 follow-ups on that. Number one, you said it right there where you said some amount. I guess the opacity for me is what that amount might be, what the trade-off might be, short-term versus long-term from the other side of the equation, meaning where might they be willing to draw that line to get the normalization of relations? And I guess the second question is there some optimistic scenario here where there is a mutually beneficial solution to be hashed out? Or, as you just suggested, is it simply a zero-sum game in a world of a rising major power for economic development? Is there some solution that might be more favorable rather than less for both sides?
I think there is a deal, but it's a function of short-term versus long-term. So I think China would likely, and this government would likely, and this is why I think it's more probable than people realize, be able to make a deal that benefits both. That's net positive for global growth, right? Net positive for both sides. That's where we were before, right? We were there. There is a equilibrium in the short term, right? That is very positive for both sides. Globalization isn't 1 + 1 = 2. It's 1 + 1 = 3. And the problem with that, and the reason we moved away from that, is because of the long-term consequences of that. We continue to go down that path, and this is not a political commentary. We will get more of what we've had, which is increasing inequality here in the developed world, right? It will control inflation. You will get growth without inflation, but that's because essentially jobs will continue to flow to wherever the water is the lowest, wherever the cost is the cheapest. That's how things work. And so the question is, are we prioritizing median outcomes in the developed world? Or are we prioritizing maximizing GDP? And we have moved from a period of maximizing GDP to maximizing median outcomes and in an attempt to put Americans, not just America, Americans first. And I think that is, no matter how you feel about politics, that's what populism is, and that's where we are. Question is, are we willing to move away from that, which again would be short-term positive globally, and to probably to both sides. So there's a deal to be made if we're willing to be short-sighted, meaning 5-10 years. Most people don't think that's a short period of time. But in the grand scheme of things, it is. And as it relates to China and the U.S. and global hegemony, it definitely is.
Yeah, these are obviously enormously complicated issues. By the way, I just had a little bit of a systems glitch there. If there's a problem with my audio, Brian, ping me and we'll recorrect it. So as we tee this up, and we talk about this sort of the balance of forces, obviously these are very complex issues. How do you find the trend line here when you weight the probabilities of these various contributing factors to the overall macro outlook that you have? Obviously, we're in this period right now between election and inauguration. Lots of things about to change. Talk a little bit about what your overall view is for 2025 and how you weight those factors.
So we've talked about this before, but you really need to be able to think about different time periods. I don't think people think enough about time. You mentioned the voting machine and the weighing machine, right? The idea here that macro, and by the way, people throw that word around macro all the time. Like macro, there's a lot of different parts to macro. There are liquidity factors in macro, like global liquidity, Federal Reserve policy, the U.S. Treasury policy, FX pricing. Those things actually really matter in a more medium term, call it 6 month, 1 year, multi-year period. But the other global things, like like the really long-term things like we're talking about, is there a deal between China and the U.S.? Are we going to have normalization of trade? Those things really matter over a decade. Those are much bigger, longer-term macro things. And those really, depending on which ones you're looking at, what macro factor you're looking at, they have a little to no factor that plays into a 1 week, 2 week, 1 month, 2 month, 3 month outcome for markets, right? In the short term, think 3, 6 months, even a year time frame, it really is just a function of supply and demand. And again, macro liquidity does affect supply and demand, but the biggest flows on a day-to-day basis have nothing to do with macro. They have to do with structural effects, which we've talked about in the options markets, re-leveraging, rebalancing effects from money in the market, broad money supply and availability of liquidity, how momentum and how capital markets are increasing liquidity in the market or decreasing liquidity in the market. These are the things that are part of the machine that is the market. And that machinery operates completely devoid of anything that has to do with opinions. It has much more to do with liquidity and structural flows. And so when you're measuring and trying to make a prediction on where things are going, you have to overlay distributions of different time frames. And those things are affected by different factors in different ways. But in the very short term, if we're talking from now to January or now to March, right, we are really, really thinking about one, what's happening with the structural flows going into the end of the year. How are those playing out? What have those done to me? Or are likely to what has that done to momentum and investment flows? How is that likely to unwind once those flows are gone? What's happening to volatility? What's likely to happen with the vol supply and the positioning in those markets as we move forward to how our market's likely to move? What's happening to interest rates? What's happening to inflation? What's happening to the global flow of money, and how's that likely to change? That's why the Federal Reserve was so big yesterday. These are the things that are really going to drive, the movement in markets over the short to medium term, meaning month, 3 months, once we start moving into a 6-9 month, 1 year period, other things start to matter. What's fiscal policy like? What is that policy going to look like? What's that immigration policy going to look like? How's that going to affect inflation? How are these kind of secondary factors that are not kind of where the rubber meets the road in terms of interest rates themselves, but these factors that are going to influence those factors, how are those changing? What's happening with tariffs? Is there going to be a date challenge? These things that we're talking about start to matter on a more 1 year plus time frame. That's when you start to have to draw probabilities of those outcomes, and then what will those outcomes mean for liquidity? But at the end of the day, it all comes back to liquidity. If you're looking at markets, it all comes back to how is this going to affect supply, and how is this going to affect demand in the marketplace? And that will, if you watch that on a detailed basis, on a day-to-day, week-to-week, month-to-month basis, and you draw probabilities to that, at the end of the day, you'll get your answer of where the market's going.
Well, there it is. You just heard it. That little sound bite right there. That is the signature Cem Karsan issue where you talk about liquidity, flows, and positioning and its impact on the shorter term price action in markets.
Yeah, I mean, that's it's actually quite simple at the base level. It doesn't mean it's simple to predict or it's simple to do all of this, but the simple idea is there are buyers and sellers. There's about a net of $75 billion a day. Sometimes it's higher, sometimes it's lower. That affects the net positioning in the markets. What percent of that, how much of that supply and how much of that demand equals out to that net? Is it going to be a net short? Is it going to be a net long? How do we get there? So there's really a mathematical, calculation here that you can do if you can get a sense of what those flows are. Now, you can't get 100%, but if you can get 50% of those, it gives you a nice keyhole into what's happening on the other side of the door, as opposed to just sitting on the other door trying to understand what may or may not be happening based on price action.
Yeah, and once you can sort of capture the swing factor, the idea is that then you have the ability to extrapolate where these sort of mathematically necessary rebalancing is going to happen. So let's talk a little bit about that. What's your summation right now as we head into the end of December for where that positioning is going to land?
So we've been very clear that there's massive amount of Von and Charm positive flows that have been supportive of markets. A lot of vol supply going into the holidays, starting in early November after the relief that from the election. Everybody was long vol because what was high was the election vol, and everything behind it was low. Now the problem with that is that doesn't last forever, right? At some point, you get that vol compression, the Von and Charm flows come, and then that de-SOPEX, which is where all that positioning was, comes off. And that's a large amount of the flows. Now we have this rebalancing, this releveraging effect, again, which we talked about January 1st, which is still sitting out there, which will continue to be supportive of markets. But that doesn't mean markets have to go up. And actually, and this is the important part, if you know 50% of the equation, but you don't really, it's hard to measure sentiment and animal spirits and positioning and other areas of the market. if you don't know that, you can get a better sense of that by looking at what you know. I think of it as a litmus test, right? If you have 50% of the flows and you're not sure what the other 50% are, but you're confident about what you have, then you can learn a lot about the other 50% through what's happening through price, right? What's happening in the market. So relative to the strength of the demand that we're seeing in the demand side of the equation, how much other supply is there? And the market's been very, very weak in the context of before even yesterday. And I was very public about this prior to the decline yesterday. But we really had been seeing a very weak week and a half, 2 weeks in the context of the strongest time to be bullish. We were kind of sitting up at the highs, kind of kept pushing them and pulling back. But that type of price action tells you a ton in the context of massive demand, right? So that's what made us come out actually about a week ago and be like, look, we're dragging along the top. We should be seeing much more strength and push here, given how bullish and how strong the flows are during this period. Warning sign, be careful. And vol is increasing, right? As we expected, the vol would start to increase before we got to January, which is when we're calling for a decline initially. So we really put out a big warning sign out there, and that was the clue. And then at a Fed meeting, which is a big important moment, you get that catalyst, and on a options expiration where there's lots of open interest, and you can get some real volatility. That said, this should continue to be a stair step down now. I know that didn't feel like that felt like a big stair, but sure enough, here we are back up this today because of these positive flows still being in the market into the end of the year. Now, this should accelerate after January 1st, January 2nd, and we believe this will be a continued step down once these positive flows, which have been very supportive underneath the hood of markets. So it would not be a surprise if we get a 10% plus top to bottom decline here. Again, we're only down 2.5% from the top. So it's not going to be a straight line. And again, it will be stair steps, but that is because there are structural forces underneath the market supporting it. So this is actually a very, very weak market. That news was very negative. The underlying news that led to that we've been talking about is very negative, which is part of why we've called for this decline coming in January before. So really think of this as a warning shot that we had. And these are opportunities to kind of scale out of markets, which have been incredibly hot all year and are really, really flagging here given how much positive flows are into the end of the year.
Yeah, and by the way, let me give you the exact quote. I'm looking it up on the screen right now. If we talk about being positive, still trailing 12-month basis, we're still up nearly 24% on the S&P 500 year to date. I mean, it's almost the same because we're at the end here, but 24.2% right now on my screen. So to your point about the overall directionality, and then this recent fade here. Here's a question about Skew. On the pricing in the derivatives market that comes from David V. Hello, Ash and Cem. Cem, do you still see S&P put options reasonably priced for short-term market pullback due to funds end-of-year risk rebalancing?
No, and when you say still, I haven't seen it cheap for a while, so I'm not sure if there's a reference there to a prior time. I still think that vol is cheap, and I think people confuse vol being cheap relative to, and a lot less cheap than it was, by the way, a day or so ago. Yeah. But I still think vol in general is cheap. But what I've been calling for, and would be very clear to people, is buying longer dated calls. We were saying that for about a month. So we said, look, it's bottoming. The vol has gotten to a 10 or below vol in the out of the money calls, 10%, 10 to 20 delta calls in the back. Those are too cheap. So it's a time to do stock replacement or to buy calls hedged. And you could lean long until you get that sign that things are not looking good, which we kind of, again, put out there as like, hey, things are not looking good. And when you do that, the way this works is you buy those calls and you sell stock delta neutral. That is a long volatility trade. People think, oh, they're out of the money calls. How are you protecting your downside? Because at the end of the day, you are short stock. And that call, which is cheap, will hedge that stock. If you go higher, you'll get more deltas as you go higher because of gamma. But as you go down, you are just net short. So you get convexity. Now, you don't get the kind of convexity you do on a put, right? You buy a 5 delta put, you have a 20-to-1 leverage, right? If that thing really goes in the money. But a call, you can hedge a 50 delta call and have your 50 your flat delta exposure go to 100 delta, right? That's still volatility, right? And that's still a convexity that you can have on that position. Those calls get really cheap on rallies because people start saying, okay, I'll write these calls against my stock position. I don't want to sell my stock, et cetera. And the volatility on them gets too low, essentially. And those are a real opportunity when that happens, because usually when you get to that point, if the market does continue higher, then you get market up, vol up, which is what we were starting to see at the end, which also is generally a good sign that we're getting to the end as well. So we've been very adamant and again, made money for about a month with volatility going up without the market really going up much or going down at all, by being long calls the back end of the curve. And the benefit of that too now is as we've gone lower, having hedged those calls, we've now made a ton of money as the calls barely moved into a big down move with volatility going up, and we've just been short stock. So that's the way to play it. It's not to buy put. Skew is actually very high in the back of the curve. It has been high for some time. That's actually also a warning sign that a decline is coming, because people are trying to buy puts and hedge their positions. There's an over demand at a high vol, relatively high vol, relative to these calls, and that's been a warning sign as well. This market's likely going to continue to decline.
And Jim, I know that explanation gets a little bit technical for a lot of folks, but is that just ultimately a function of the fact that you've had this kind of performance in the equity markets? Everybody's long, and there has to be a hedge on that, and that is what just happens as a mechanical necessity of hedging those long equity positions.
Yes, there's always skew in the marketplace because of what you said. Because the world is long, you have to have skew. It's like an insurance contract, right? Insurance will always trade for a premium. Nobody's going to sell you insurance for negative, for a negative expected value, because they're taking risk in order. This is not a normal distribution of outcomes, right? And they have to manage that risk. That's what's called risk premia. Yes, there's massive risk premia in the markets, and it's one of the biggest carry trades in the world. I mean, to give you a sense, at a 20% out of the money put 3 months out probably trades at a 40 vol, right? While the call trades at a 15 vol at a similar percent out of the money. You can own one, sell the other, and be short stock. And that isn't, the market goes nowhere. You make a ton of money. If the market goes down, as long as that out of the money put doesn't go in the money, you're not only short stock, but you're collecting this massive premium. And the call in theory is cheap enough that if you rally at some point, it tends to go higher. So it's an incredibly profitable trade. Think of it as a carry trade, just like you would yen lira or any other carry trade. These are structural things that are a function of bigger issues. That doesn't mean there's not a tail. It's not a free lunch. So this is the biggest carry trade in the world, which is Skew. It's the biggest carry trade in the world because it's hedging the biggest thing in the world, which is long exposure to everything. We're all long. We're long if you sleep, you breathe, you own a home, you work a job, you own equities, you own whatever you own. You're long, and the only way you can hedge it is by finding somebody that charge you a risk premium and give you a hedge. And that makes everybody say, well, why would I ever buy that? It's so expensive. Because it's the only thing, literally the only thing that when the world blows up will protect you, because everybody else is also short that tail.
Yeah, and of course the however is where the price comes when you talk about no such thing as a free lunch. I guess the challenge is if people trying to conceptualize this and get their heads around it, right? It's this idea that you get a free lunch every day. Day after day after day, and then one day the bill comes due in the form of the repricing, the unwind of the carry.
Yes, but there are ways to do it better, and there are actually ways to do it at little to no cost, and that is by when the calls get cheap. Don't go buy the Skew. Don't go buy the put. You can buy volatility. It may be less convex. It's still convex, and you can go buy the out of the money call, which is cheaper, not just cheap. Those actually have an expected value of about even. There's no premium net charge for that. And you can buy that and sell stock, which is not short, not short Skew per se, right? It's long the call, short stock. And that is the closest thing to an edge in the vol market for being long vol. Again, you only want to do it once those things get cheap enough, but that's the way to actually do it on a best risk-adjusted basis. Won't give you the same convexity, mind you. It's not the home run lottery ticket, but it is a much better expected return. and does get you convexity still.
And that's a pretty good summary of what it is that you do.
That's it. It's that simple. Just buy calls, sell stock. No, it's there is that is a part of a much bigger, nuanced volatility world that we live in. But I will say, as we mentioned before, the options markets are, if you become a student of those markets, you get a much bigger picture on how the whole machine works, because you're no longer looking at things in 2 dimensions. You're looking at it in 3 to 4 dimensions. And you can see that data in real time. It sounds like it's a very futuristic, crazy thing, but it's just a very much more precise, data-rich data set and framework with which to think about the world and all assets.
Yeah, and by the way, the complexity there, of course, is in the timing, the sizing, and the pricing.
Absolutely.
Okay, here's a question from DK who says, "Hi, Cem, big fan and follower. Love your market framework. Very tactical question. Do you see these oversold conditions leading to new highs before end of year?"
I don't. Pretty simple. No, I did see a bounce coming this morning. It should be a bounce that lasts a day or two. I think into the end of the year, you still have support. So yeah, we could go sideways, maybe even bounce a little bit more. But we're not going to new highs from here until after, in my opinion, until after we get a little bit more, not a little bit more, a decent amount more downside. That'll probably accelerate after December 31st. I would say Jan 3rd to 6th. That window, I would be very, very. We could circle those dates. They've been moving forward, given the price action and what we're seeing in supply and demand. But I would see an acceleration down. Again, that doesn't mean the world is ending. It doesn't mean that it's a crash. Doesn't mean you should go buy puts, which are expensive. It means that you should be tactically looking to short and find ways to buy cheaper ball on the call side when possible to get short against it as well.
Here's another question from Frank. Cem, can you explain the path you see in the bond market? Do you see a potential growth scare next year slowing down this recent move in the 10-year as most people have finally moved out of recession camp? Or do you think it blows by 5% first as inflation remains entrenched? This gets back to some of those macro questions.
Stagflation. We've been calling for it for some time. I think we are heading more and more to a point where structural inflation is going to take a bite out of demand as well, and that structural inflation will keep inching higher, even unfortunately into a decline. I think if we do go into that long spoken about recession, which I don't think is likely, because we're running a really hot demand push economy, much like the 1960s and 70s, I think we are likely going to continue to see a relatively sticky inflation in the context of that as well. So the truth is not two-dimensional. Everybody has thought about inflation in cyclical terms. When you talk to most people, even bond traders from the last 40 years, everybody thinks and talks about 10-year bonds and inflation in the context of are we entering recession or are we not? That's the cyclical factors are the ongoing factors that happen in all cycles. But we have gone from a very structurally secular deflationary environment with all the globalization and low interest rates, et cetera, to a structurally inflationary environment on the back of populism, protectionism, higher interest rates, et cetera. And so now that really changes the inflationary outlook. It makes it really hard to pull down inflation. Actually, what that ultimately means is that the inflation is the thing that slows the economy. And so that is a stagflationary environment. We're there, in my opinion, for the next decade on and off. It doesn't mean interest rates will come down at periods and that we won't see some lower inflation relative to as we've seen, right? Inflation came down from much higher levels, but here we go again, secularly pushing higher. And so we just expect a long-term 10 plus year structural march higher inflation with big rallies and big drops, but the trend is higher, and that's a problem for the stock market broadly over this period, as well as obviously the bond market.
We talked about this a little bit before. We talked about this in terms of structural macro terms. I know we're shifting hats here a little bit, but it's I think an interesting point where you sort of made this reference to the idea that the that we've gotten growth without inflation, and what the cost has been in exporting some of those jobs, a significant number of those jobs, is that you have an increase in inequality here at home. Here's a question, which is, to what extent does automation and AI play into these? Because this is something that really just hasn't yet been fully priced into the market. I know you've seen some of the trades with tech stocks going ever higher than the ones that have the best exposure to it. But the sort of structural systemic question of what happens when you have this total factor productivity decrease in cost, increase in productivity as a consequence of AI and automation that's just beginning to be seen in markets in terms of the capacity for production.
About timeframes, this is not, by the way, the first. Everybody thinks that the new technology is a step function relative to the past. We thought that with the wheel, I think, when the wheel was invented, right? Progress is always happening. Now, the speed, I think people give too little credit to the speed and acceleration of progress being a function of money supply. Part of the reason we've had a technological boom in the last 30 years is because interest rates have gone from 20 to 0 until more recently. That's driven a venture capital boom. It's what's driven inequality, right? That's what's driven inequality. We've been sending money to capital. But if you send money to capital, what happens? Capital is all incentives. Capital has one incentive: to make profit. How do they make profit? Two ways. Either find a lower means of production, which creates globalization, or they come up with technological innovations, right, to push them forward. And not only do they do that to lower their costs, but they do it, it becomes an ecosystem where companies are creating more technology to lower the cost, to provide these services to other corporations. Capital markets drive innovation. What happened to the Mesozoic era? We put more oxygen in the environment. There was more oxygen in the environment. What happened? The dinosaurs just got really big. I mean, it's simple, right? You give enough money into corporations, and over 40 years, you not only see massive inequality, but you see technological progress and globalization. That's what we've seen. And that's structurally very deflationary. But what happens when that inequality gets so big? Well, at some point, people say, well, wait a second, love the technological innovation, but I need to feed my kids, right? And then we take money from capital and we send it to labor, we send it to people. That's a demand push economy. That's not a supply side economic model. And that's inflationary because the velocity of money when you send it to individuals is 1. When you send it to corporations, it is 0. And so that inflation ultimately raises interest rates, takes money from capital, and slows technological progress, unwinds globalization. And this happens over decades. This is what's coming. This is where we're heading. And we've been talking about this for years. It continues to walk down this path. Now, when this happens, that takes money from venture, that takes money from corporations, particularly growth companies who don't have revenue to continue to create technological innovation. So you tell me, Amazon, Uber, Tesla, all these companies didn't make money for 20 years. How do they make money for 20 years? How do they develop these amazing technologies? How do they change our lives? They did it on the back of 0% interest rates. We've had no other period in time where you could not make money for 20 years as a corporation and simply based on eyeballs, right, or interest, get money again and again to take over market. That's great. It's wonderful. It's capital markets at their best. But that drives massive inequality. And so if we stop doing that, how is that next corporation that wants to that next AI company or whatever company it is, how are they going to not make money for 20 years? They can't. They have to make money now or they don't have funding. And so that makes it a lot harder to grow technology, and it also takes away from globalization. It also decompresses margins. Right? At the end of the day, we're at record margins still. Right? Why is that? Because of globalization, because of technology, because of cheap interest rates. Those margins compress as interest rates go higher. This is really poor for equity markets and really particularly poor for growth and technological innovation. So I would argue that, much like we always do, we look at the trajectory we are on and we look forward. We say, oh, well, we're going to keep going in this direction because that's where we're going. But I think the key to doing this right is to think about what are the inputs to that trajectory, because things don't always continue in the straight line.
Yeah, and even if the overall directionality remains the same, the rate of change decreases perhaps dramatically at the margin.
We're always going to get technological innovation. I'm not saying that we're going to zero and that we're no longer going to grow or create new ideas or evolve. That's been the case. Progress is the one constant in life, but we grow at different rates and in different ways, and those sometimes can be dramatic changes in trajectory.
Yeah, it can be very difficult to see because decades-long time horizons to human eyes can look like they're unfolding on a geological timescale, even though they're not. There's the idea of the way that we perceive things. Something that's been in place for 20 years feels like forever to us, right?
It's been a 40-year cycle. 40 years since 1982 when interest rates peaked, and then we opened up to China. We went from a demand-side economic model to a supply-side model in every single way. 40 years. 40 years is 2 generations. Very few people will look past 40 years. Have you ever seen a trading product come to you and you say, this is my 100-year track record? Every model, everything that's been built, every economic, all of Wall Street and wealth advisory is 60-40. Why? Is it because 60-40 wasn't an idea that people had before 40 years? No, it didn't work prior to 40 years ago. It literally did not work. Since 68 to 82, equities lost 65% of their value in real terms, while the bond market lost more than that. It not only didn't work, you lost all your money if you did 60-40, if you did it for the 15 years prior to the last 40 years. But nobody looks at that. Nobody cares about that because the whole system is built to profit from what has happened. Because 40 years is essentially forever. And that's what's a big contributor to these cycles. Everything, the pendulum swings and there's a momentum factor and it goes all one way. And then everybody starts to say, oh, wait a second. This wasn't a real long-term trend. This was a generational thing. And so I think particularly in wealth advisory and capital markets, people have really lost sight of how much of a contributor interest rates going from 20 to 0 was secularly over 40 years. And that globalization, everything else that was part of that has had to do with the performance of assets. I think once you unwind and then you start saying, wait a second, what if interest rates go higher? Seems like a crazy thing. By the way, whenever I say that, people are like, how could we do that? We have so much debt. We couldn't possibly, interest rates couldn't go higher. What happens if they do? And I'm here to tell you, it is exactly the opposite of what we've seen the last 40 years.
So interesting. There is your big idea for the week, thinking about these things across different time horizons. Gosh, what a great and interesting point. I want to end on this just because it's one final question that's interesting. Maybe we can talk a little bit and tie this into the longer term trends. But here's one from Mr. Hunayan, who says, where do you see Bitcoin going? What is your opinion for new investors coming into Bitcoin for long-term investment? Bitcoin holding its chin up above 100K now, despite some downward momentum over the last 36 hours.
Bitcoin is and will continue to move towards being millennial on down gold. What do I mean by that? Gold maintains its value as a function of people's belief that it is worth something. It's about confidence, right? And you have to understand the history of Bitcoin. The reason that it exists is because generationally, millennials on down, who were labor, have suffered due to monetary policy. We've seen massive inequality because of monetary policy. For 40 years, labor in the United States, particularly the youth who have represented labor, have dramatically underperformed. They're at 40% or now 45% of the wealth creation and household formation that baby boomers were at this time in their life cycle. They've been living it with mom and dad in the basement, trying to get out, trying to buy a home, unable to start a family. That's real. That's what's driving the populism because they're now coming to political dominance. And that populism and that policy, whether it's Trump or Bernie Sanders, right, is where we're going for the next 15 years. Look to millennials on down and give them what they want because they're going to get, invest in what they want because that's what's going to succeed in the next 40 years. Bitcoin is a representation of that. They grew up in this 40 years of technological development we just talked about, right? A thought that technology can solve all of our problems. And our chief problem was inequality and monetary policy. So Bitcoin was created by this generation to solve this inequality problem, right? Through technology. It's a perfect solution, right? And in the meantime, this generation has been underperforming dramatically, and they're looking for convex ways. This whole YOLO mentality is because they need to catch up. They feel desperate, and the only way they can do that is take more risk. So this is the embodiment of that generation. And if we are going to get inflation, where do you think people are going to store their money as a store of wealth? Do you think millennials on down are going to store it in gold or Bitcoin? So it's not that gold won't do well in an inflationary period, but I think Bitcoin participates in that way. There are other factors. We have deglobalization, which we already talked about happening too. If that continues, people need to get money out of these other countries. And Bitcoin is the perfect way to do that. So there are multiple trends, right? Not just inflation and it's a store of wealth, but millennial demand and increasing money flowing to millennials who will have more money, who will then invest in Bitcoin. Paired with the deglobalization, the need to get money out of emerging markets and other parts of the world into a more stable place. That is what's driving the super cycle. And the thing about an asset like Bitcoin is it's a confidence game. Same thing with gold, by the way. This is not an indictment. People, if they believe in it, it will be true. It has gained enough scale. And it has a sponsor in the sense of the biggest, growing group that is getting money that is politically dominant to back it. Now, to be clear, that's a decade-long thing. But at the end of the day, we have to ask ourselves, because there's no true sponsor to Bitcoin, meaning a government or a source of power that is somehow centralized, think the U.S. government with the dollar, right? Or other assets. At the end of the day, does it threaten things like the exorbitant privilege of the U.S. dollar? Does it threaten power structures large? Yes, that's what it was built to do. And so at some point you have to ask yourself, are those entities going to continue in the long term? Never mind Trump. And part of the reason it's rallied so much lately is the big threat to Bitcoin is government intervention. Much like the U.S. unpinned itself from gold, right? Because it didn't want to be tethered by something. The reason we have the exorbitant privilege of the U.S. dollar is because Nixon untethered us from gold. Does the U.S. government want to be retethered by something like Bitcoin? And the answer is no, it doesn't. And power structures ultimately will not allow these things to exist in the long term. That doesn't mean the next 10 years, Bitcoin won't continue, maybe 15. We're talking about long-term cycles. So you have to be bullish. You have to be long of Bitcoin. It's not going to be secular. It's going to be volatile. The most volatile asset in 68 to 82 was gold. It was also the most positive asset. So it's going to be a very volatile ride. There'll be big dislocations along the way. But you have to be bullish of both gold and Bitcoin with the understanding that if regulatory oversight starts to take hold on Bitcoin, which again I don't see happening anytime soon, meaning decade plus, that is going to be very, very bad for Bitcoin for quite some time after this is done. Think of it almost like gold.
And there's also this question of the timing and processional effects, where if Bitcoin is allowed in these early years to get that growth path forward, if it scales, it becomes much more difficult, I think, to restrain just from a purely technological perspective. That if this is not something that gets strangled in the crib, it seems to me, at least, that it gets a kind of toehold that becomes very difficult technologically to disintermediate.
Yeah, the only way you really could is by massive regulatory changes. Yes, the U.S. government, being the biggest economy in the world, could relegate it to backwaters. That's the threat. And the second Trump and Elon got voted into office, that threat came off the table for at least 4 years. That's why you're seeing a dramatic rally. Pair that with the structural inflationary forces that come along with Trump and that we're in broadly for the decade is part of why you've seen this massive reignition of the asset.
Yeah, and I guess in democracies that becomes harder to do when you have broad-based ownership of an asset, right?
That's right. That's right. At the end of the day, it threatens the power of global powers. That's why it was created. And you have to ask yourself, in the long run, will power allow that to happen? The history of not just humankind, but animal kind says no. But those are long, long time frames, not decades.
Cem, I don't know the answer to any of those questions, but I'm always continually impressed by your ability to shift gears from talking about the most market micro mechanics into these bigger picture questions. It's one of the reasons why we, and I know our viewers and listeners, enjoy having you on Real Vision so very much.
Very kind. I enjoy it. I have a passion for it. And there's a lot. This world is very interesting. So the more we can dive in and think deeply about these things, the better for all of us. This is truly what moves everything. It's less about qualitative and more about thinking about incentives and reactions in the big picture. So thank you. Kind words. Happy to be here. Thanks, Ash.
Cem Karsan, always a pleasure. Thank you for joining us. Thank you for watching. Thank you for listening. Have a great day, everybody.
So within this, we have parties. You can choose the VIP track, and then you might be on a boat party and you're doing something else and going for a dinner there, or meeting people in different venues and bars. So there's lots going on. It's like a mad treasure hunt. I like the idea of just hanging out with you guys, drinking a rum or a glass of champagne and putting the world to rights and just really celebrating you as our members and our community. And it's a thank you for that as well. It'll be an incredible event. Listen, get your tickets quick before they sell out. This is the event you've been waiting for. Come and join us for the crypto gathering. We will have an absolute blast.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.